Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So, as a trader of FX options, there are really three ways that you would look at volatility data like we've discussed here. You would use volatility charts to manage risk. If, really what you use FX options for is, to hedge, maybe there's some of you in the audience who, work with a bank or with a multinational company who has actual currency risk. And you need to understand how to hedge that risk. Well, are you buying an overpriced insurance policy or a fair value insurance policy? Or better yet, a cheap insurance policy? You got to know. You tell your boss, hey, look, I just, I bought some puts on here. And, if your boss is a smart guy who understands option volatility, he may look at this and say, what are you, crazy? You just bought the most expensive options that you could possibly buy. You screwed this up. You can't just go out and buy a put blindly and think, oh, yeah, everything's great, I'm hedged. Is it fair value? I mean, you've got to really get down there and look at the volatility value to see if you're overpaying or underpaying. And, if you need to buy those puts, there are some ways where you can spread off risk, which are a little bit more advanced than what we're talking about here, but the stuff that I talk about with students sometimes in some of my online presentations. And if you're not a hedger who actually uses options to hedge existing positions, if you're a trader, you use volatility charts for edge, like I was saying. Hey, if I'm speccing on direction, should I buy a call or should I sell a put or sell a put spread? I can take a bullish position either way. Well, if volatility is expensive, I'd rather sell a put or a put spread. If volatility is cheap, I'd rather buy a call or a call spread. That's how you make smart decisions. Using volatility for edge. That is the one edge that you can have over the market makers, in my opinion, over other traders, because you know what? A lot of traders out there, don't take a clever approach to trading. They just go out there and, say, well, all right, let's buy some calls, and don't even look at volatility. You can outperform other traders by getting the edge and making smart decisions here. And then a more higher level way to look at volatility in currency trading is to actually trade the volatility. Buy cheap options and wait for Vega to rise and sell those options out and just make money from Vega without the underlying even moving. Or sell expensive options conversely and profit if Vega falls. Or if implied volatility falls. Profit just from Vega and don't even worry about the changing price. And here's an interesting comment here. This is like an after-school special announcement here. It says, vol kills. Is it the difference between historical volatility and implied volatility, or their ratio? Yeah. For example, 7% versus 11% is the 4% difference, but 60% more, so it's similar to a bio stock before FDA approval. Do I need to refurbish my view? No, I'm gonna do a little bit of paraphrasing and explain here. So, yeah. Implied volatility and historical volatility are both stated in percentage terms. The annualized standard deviation, which is a percent. So if you're comparing a 7 volatility to an 11 volatility, you don't say, oh, vol's 60% higher. Just look at it as, points, okay? Look at it as points in terms of volatility is 4 points higher. because if you think about it, that 4 points translates into Vega. 4 points times Vega gives you the dollar value that the options are different, right? So yeah, it's the difference between implied volatility and historical volatility. And, don't let me oversimplify here. Also the difference between current implied volatility versus past implied volatility. So yeah, look at it numerically, like as far as points go. Now, I'm going to mention something here that I do that might be of interest to some of you. My online education series. Here's what I do every month for my students, and then I got a couple more questions that are going to be of interest to you. Every month, I present a 4-part online series, and it's basically an online seminar each Thursday of the month, and each month I pick a different topic. Like this month, November, for example, was all time spreads. Next month is entitled 12 Steps to Success, and it's my trading methodology. There are basically 12 steps to every trade that you make. Whether you're a brand new trader just learning about calls and puts, or a professional trader who's been trading for 20 years and you're a prop trader in a fancy office in Chicago or New York. You go through these same 12 steps, and it provides a really, really great checklist for you. And I kind of go pretty deep into this topic, and it's essential. It's one of the most important series that I present. So there's one on December 2nd. The next one in the series is December 9th. Next in the series is December 16th, and then December 23rd. But it's not just these 4 live presentations. I record them so you can watch them anytime you'd like, but I also have the past 6 months of presentations recorded. So that's another additional 24 1-hour and 15-minute presentations. So you've got over 30 hours of material here, plus some online tutorials, online videos, and some other trading tools.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.